Okay, good morning everyone once again.
Good morning.
Thank you for joining us on today's Real Estate Insights training. My name is Toluwani Akinyemi and today we're going to be considering risk management in real estate investment. Risk management in real estate investment. Now, just like with any other investment types we have, stocks, bonds, shares, real estate investment also has some risk attached to it, right? So generally, when you go into an investment or when you invest, the idea is you're putting your money into an asset or a venture, whether financial, shares, stocks, cryptocurrency, with the intention of getting profit from that particular investment. That's what investment is. You want to gain capital appreciation, you want to get income from it. That's why you put your money there in the first place. The same thing goes for real estate investment. You are buying that property with the intention that over time it will appreciate in value, or you can gain annual rental income, yields from it, annual returns essentially from your investment. That's why you went into it. But there are certain things that could impact the profitability of your investment or the long-term success of that investment. But make no mistake, if you manage your investment properly, real estate has a lot of benefits it could give, from capital appreciation to serving as an edge against inflation and building sustainable wealth. If you see majority of the people that are associated with wealth, even in our country, one thing that they have is real estate. They have properties, right? A lot of them that they could even live for generations to come. Here that they have in Abuja, they have in Lagos, they have in their own state. So they have various properties they could live for generations to come. So that's what real estate investment affords you. Now let's go into the meaning of risk. Risk refers to the possibility of losing money or not achieving expected returns due to various reasons. So risk in an investment means I have put my money into this venture in real estate, but there's something that could make me not get the achieved returns that I envisioned I would get. Imagine if what you expect on an annual basis is 1 million in rent from your tenants, but one way or the other, what you're getting is less than that. There's also the possibility of getting something higher, but when you get something less than that, it means that there was something that impacted your investment and did not allow you get the returns you're supposed to get. That thing is what is known as risk. Now, risk management is the process of identifying, assessing, and mitigating this risk to achieve investment goals. Now, risk management is normally supposed to come into place even before you go into the investment, or let's say at the start of the investment. So what most people do in most cases is they started getting the impact of the risk, right? They started feeling it, something's already affecting their investment. Then they start looking for ways to avoid it. So what can I do? That's kind of like curing it instead of preventing it. So risk management is identifying what are the things that could impact this investment even before I go into it. Or I have gone into it, what are the ways I could just ensure to get the most from my investment? That is what risk management is about. Now, generally, real estate investment is considered to be low to moderate risk investment. It's considered to be low to moderate risk. But there are also certain investments you can go into that can come out as being high risk. If you are trying something that there's probably no data to help you or to guide you, you're literally just trying it out of interest or out of curiosity. It's a novel investment. You are kind of like the pioneer. In such case, it's very high risk, but you know what you intend to gain from it. You believe you can be able to get profit from it, is why you are going into it. But generally, because real estate, most times, there are things people have done before. So you're literally just following in that path. It's considered low to moderate risk. Now, there are various types of risk that is inherent in real estate investment. The first, you have market risk. This comes about due to fluctuations in property demand, in pricing, and in rental yields. An example of this is an investor that gets properties, that buys apartments in Lekki. Obviously, you have the intention that when you buy apartment in Lekki, you have the intention to use it for short let. The expectation is you get very high profits from it. But imagine a scenario where in the area where you got properties, then there's an oversupply of development in that area. Everybody too is thinking short let. And so everybody is building things that could even throw you off the market in terms of luxury, in terms of what it looks like, right? In that case, the investor will not be able to get his up in terms of returns from that investment, because you are not the only one thinking, of going into short-let apartments in that particular area. Then another thing, another type of risk are regulatory and legal risks. This comes about from changes in government policies, taxes, or zoning laws. So an example of this is somebody that buys large hectares of property in, say, somewhere in Ogudu, somewhere in Ikorodu, somewhere, just buy large acres or hectares of property, or somewhere in Ogun State, for instance, and you want to use it strictly for residential use. You've bought the properties, maybe you've even acquired loan to develop the area, you want to build an estate, and then government suddenly rezones the area as commercial and says no residential development in this area, all commercial. In that instance, the person will probably have to change a lot of things, the development plans, your architectural drawings, just to be able to fit in. In some cases, the person will actually just sell off their investment because that was not their intention for buying that property. So this is an example of a risk that can come about. And in this case, most times, it is not the individual's fault. There are certain things that could come about that you never foresaw coming, right? And then it happened. Then we have financial risk. An example of this is someone that secured mortgage with, the intention of probably doing property flipping. You bought a property, you want to remodel it, you want to renovate it, and then sell it off. But all of a sudden, there's an increase in interest rates such that you're not able to pay back the mortgage, and then your property gets foreclosed. So the whole venture just goes down the drain. That's an example. Something that gets changed due to changes in the financial sector. So we have market risk, regulatory and legal risks, then we have financial risk. Now, operational risk comes about from challenges in property management and maintenance. For example, you're a landlord, you have a property in Surulere, you rent it out to a tenant. One way or the other, the tenant stops paying rent after a while and even damages your property before leaving it. That's an example of operational risk. Or you got somebody that is not competent enough as an agent, and then you just get someone that every weekend is oblate, every weekend they party in your house. By the time they will leave your property, the kind of damage they would have done is an example of an operational risk. Now we have natural risk. We are very conversant with this. It comes about from flooding, erosion, or environmental issues in the area. Very good example of properties that suffer this are sometimes properties in Lekki, where you bought a property worth millions of naira, but somehow when it's rainy season, you can't even access the property in the first place. What this will mean is that you have a lot of expensive repairs to carry out, or you will have low tenant demand, because if the tenant rented it one time, second time, nothing spreads fast like rumors. So whenever people come and check it, people will tell them the area, that property, when it rains, you will need a keynote to get to your house or your apartment. So obviously, tenant demand for it will go down. So you have lower tenant demand for such property. So this comes about as a result of natural risks. Now let's look at some of the ways we can mitigate this risk. Yes, let's look at some of the ways some of the strategies for us to mitigate and manage this risk. For market risk, the first thing you want to do is diversify. Do not invest in one market. Do not put all your eggs in one basket. Sometimes when we advise our clients and we say, oh, this is the amount you have, you want to invest. You have 20 million, you have 50 million, you want to invest. We advise you, don't just buy all the properties in Nepe alone. Look at Abuja, look at Ogun State, look at other places and put your money there so that you can gain a lot overall. If the real estate market in a particular area is not doing well, you can get something else from the real estate market in somewhere else. Because real estate market is not universal. One thing does not affect all the markets, right? So you want to look at diversifying, then have a long-term perspective to real estate investment. If what you are doing is not property development, even if it's property development, we usually say that it's not easy to liquidate real estate. The possibility that you put your property on the market today and get it sold today is very slim. So you have a long-term perspective, especially when you understand the purpose for which you are buying. You are buying for future use. You are buying for long-term investment. You are buying as land banking. You are not buying today and selling tomorrow. And that's why to most people, they feel they are not getting enough from their investment. It's because what you are trying to do with the property is not the intention for which it was started or the investment was started in the first place. Then data-driven decisions. Use property analytics to make your decisions before you invest in an area. That your father did it in that area in 1998 is not justification for you to buy in the same area. The market could have changed. What is the market saying now? Is it something worthwhile for me to put my money into? How long will I have to wait? Because there are times where you buy a property, right? And you would have to wait 10 years when you're in terms of collecting rent before you get the capital you invested in that property in the first place. So you should not be in a haste to say, I bought this property now, it's been 2 years, I've not, what the tenant is even paying me is not. Obviously, that's where real estate market works. So you have to wait and ensure that I can get value for what I have invested in before you take your money out of it. Next, operational and natural risk management. So for operational risk management, hire reliable property managers. Here we call them web advisors. So hire very reliable ones. do your tenant screening, do your tenant profiling before you allow people to move into your property. While I was doing IT, there were certain landlords that would say, if the person is not earning on a monthly basis, I want proof of income on a monthly basis. There are certain landlords that would say they want to meet with you and have interviews with you before they hand over their properties to you, because they know what, even if you're a business owner, they would interview you. For some of the properties, for the property we rented in saying, we had that experience. The landlord interviewed us, the agent in charge rather interviewed us, wanted to get to know us. What do you do? I will check out the company before I give you my property. So carry that out very well. Then for natural risk management, insure your property. Cover your property against theft, against natural disasters. Yes, in Nigeria, we've never had earthquakes. I don't know if we've had, but it's very rare to hear of it, right? Earthquakes, I will not have in Jesus' name. Amen. Please insure your properties. Because when it has, you cannot go back and say, I didn't think it was going to happen. There are also times you should also insure your property against theft. All of these things could come up as operational risk. Because imagine a scenario, there was somebody that I met about 2 Saturdays ago. She said when they went to work, she and her husband, before they got back, some people had come into the compound and they're taking all their condensers or something, their AC. So they were literally left AC-less. They've taken every single thing that makes sense to make the thing an AC, right? So you have to carry out insurance. Insure your property, cover it, sign the proper documents, and pay, because some very little amount they're supposed to pay to insure your property is what will save you when certain damage are done in the long run. Then for financial risk, secure favorable funds and have emergency funds. As a landlord, when you become a landlord, do not use all your hands to eat. Don't eat all of your harvest. Keep some money apart for when tenants would move mad and do damage to your properties, so that you do not have a scenario of a long time period where your property is left void and you're not getting rental income from it. Right, so you have to do that. Then if you are going to be doing a very large scale development, then you can negotiate with banks. You don't necessarily have to take what they give you in terms of percentage that you have to pay back and the rest, so you can negotiate with that. But more importantly, keep some money apart. You never know when it will come in handy. There are some landlords too that would insist tenants should deposit, caution fee and all of those things. Do not spend it, it's not your money. So that when the tenants do damage or cause damage to your property, you can always match up and do it. Therefore, regulatory and legal risk. Stay updated on policies. Find out what government is saying in this particular area before you go into it. We have the example of people that had properties along that Calabar railway. If you have the property there, you will not sleep. You'll be checking. Is it expanding to my side? What exactly are they saying now? What documents do I have? So you even know whether you have to get ready to fight or not, right? So you have to keep updated on policies. Do not buy a property, especially if you do not buy from the reliable source, and just sleep on it. It doesn't work that way. There was somebody that I took recently for a site inspection, and the man was telling me, oh, he has properties in Shiwama, and in my mind I was like, this Baba FTO. You have properties here 20 years ago, you've not gone to check it. You don't even know what the government is saying about this area. You don't know whether it has been compulsorily acquired, whether it's supposed to be filing for compensation. So stay updated on policies. Then get professionals, get people that know what the market is saying, that have adequate knowledge. There are certain things that a realtor can do. There are certain information that only a quantity surveyor can give you. There are certain information that it's best it comes from an urban planner. So get professionals to help you out. Now, before you invest, there are certain ways you can assess this risk so that you can get the best from your investment. The first, we mentioned it already, market research. Find out what the market in that area is saying. What a property analysis. There are people that will tell you that in this area, if you buy this property now, this is what you can give or get as rent on an annual basis. If you were to do on a monthly basis, this is what you can get on a monthly basis. So find out all of that. Do your due diligence. The documentations, do your due diligence on the documentation, on what you get in terms of property research, who owns the property. Make your due diligence and your research. Then your financial feasibility. Do I have the money to even go into this investment in the first place? That's something you should look into. Now, I'll give examples of how people do it. Customers, villa owners we meet, how they do this. If, for instance, you've gone to camp, you will find out that they actually do all three. Market research. They find out, okay, they're telling me to invest in Ogun State. They Google what is in Ogun State. Sometimes we'll tell them there's a cargo airport coming. There is this in that area. Things that signify development is going to come soon. So they begin to make their research. They begin to get familiar with the area. Okay, what area are you telling me? they put it on Google Map. They want to see how many minutes from their houses to the area. Then next, they do their due diligence. We proudly tell them, go and check us out. We've been in existence for so number of years. They check us out on social media, they check us out on Facebook, whatever, and then they come back to tell us, oh, I've checked you guys out. This and this is what I found out. Sometimes you even give them your personal profile. Go and check me out so you know that I've been with this company for so number of time, right? Then they come back to tell you, I can actually do 12 months, but I want to do 24 months just to be sure, right? So that I do not buy my property and then the next number of months I'm not able to complete. There are those that will tell you, I can do outright, but I'm not so sure. Let me just do 12 months. Or tell you I can pay in 6 months, but what you have is a 12-month plan, Abi. Let me sign up for that. So those are certain things you should do. Find out if the area gets flooded. Do your analysis before you then sign the deal. In conclusion, real estate investments, like we've certified already, it has a lot of risk, but it also has a lot of rewards. If you permit me to say, the rewards are even more than the risks, because certain of the risks are within your control. There are just a few others that is not within your control. Then keys to success: make your research, diversify, get 2 plots here, get an acre here, diversify, have in several locations, then engage experts, people that know what it is they are doing, so that you do not cry at the end of the day. As an investor, focus on understanding the local dynamics and planning for contingencies. So you want to focus on understanding, what is this market in this area saying? I cannot emphasize it enough. Find out what exactly the market is saying, and then plan. Okay, look at this, look at this, look at this. I'm sure some of us have seen some of the construction that is going on at Allen Avenue. When we started last year, because I think it started towards the end of last year, nobody would have thought anywhere that there will be any need to do anything again on Allen Avenue. But certain people have planned for it, if you ask me, because there are certain companies that have seen that after they broke down their fences, they still had enough space to come back and then start building again. Those people have basic understanding. There were others that literally started from the entrance of the road, and government has able to shift inside now as you were supposed to. So you want to plan for contingencies. Don't just go ahead to carry out your construction. You believe you know everything because you've been building for 50 years, even though you are not a professional. So if you have any questions, contributions, suggestions, we'd like to hear from you. So leave us a comment in the comment section, and we'll get back to you as soon as we can. Thank you very much for staying with us.